Dear investor, Edelweiss Private Wealth Management is pleased to present you the latest issue of Investment Strategy Report for January 2019. Let's take a look at key highlights of December 2018. US equity markets saw one of the worst Decembers till Christmas and plunged to 52-week lows. Most emerging markets are also witnessing slower growth and tight financial conditions. Trade wars have likely led to slowing of manufacturing production in a number of countries, especially emerging markets. This is likely due to reluctance in the manufacturing sector to pile up inventories ahead of any tariff surprises. Commodity exporting emerging markets are dependent heavily on growth in US, China, and other developed markets. Slower growth in these markets is likely to keep these exporting countries under pressure. In India, crucial macroeconomic factors like inflation and trade balance have stabilized as crude oil prices continue to fall. While the Monetary Policy Committee decided to keep the benchmark rates unchanged in December 2018, to give elbow room to deal with tight liquidity situation, it has decided to undertake OMOs aggressively. As per our estimates, financial year 19 EPS is at 507, thereby implying a 12% growth over financial year 18 EPS of 445. If achieved, this will be the highest EPS growth rate in the last few years. Bloomberg Nifty blended forward 12 months. Bloomberg consensus PE stands at 17.3x currently. While markets are not expensive, they are not in the cheap territory also. Indian equity market at a broader level still seems relatively expensive as compared to its peers in the emerging markets. This is because of the fact that the correction in Indian equity markets has been primarily restricted to mid and small cap universe. The diversion in performance between the various market capitalization stocks is evident from the fact that Nifty index is almost at the same level as beginning of CY 2018, while Nifty Mid Cap 100 Index has fallen by 17% and Nifty Small Cap 100 Index has fallen by 31%. Our view about equities as an asset class is neutral. We advise investors to focus on certain stock-specific bottom-up opportunities as the broader market is likely to come under pressure in the backdrop of negative global news flow. Improving macroeconomic parameters may open up opportunities in the mid and small cap space. Valuations in small cap space have corrected and are now approaching attractive levels in many sectors. India government 10-year bond yields have declined by approximately 100 basis points from their last quarter high of 8.25%. Farm loan waivers and other revenue expenditure clearly highlight risks of pre-election populist measures. This would keep fiscal deficit expectation tight and present significant risk to bond markets. Liquidity in the corporate debt market remains tight, but is slowly mean reverting. We expect rates in the short end of the corporate debt market to remain sticky for now. RBI's liquidity infusion through OMOs is now the elephant in the room. The highest OMOs done by RBI was in financial year 13, amounting to approximately INR 1.54 trillion. As on financial year 19 YTD, RBI has already infused liquidity amounting to approximately INR 1.87 trillion. It has also indicated its intent of doing INR 500 billion of OMOs each month till March. This would lead to infusion of more than approximately INR 3 trillion, which is significant. Given the continued liquidity infusion by RBI through OMOs, we believe GOI 10-year yields have a cap of 7.5% to 7.7% on the upside from current levels. We expect rates both in short end and long end to be range-bound in near term as inflation stays benign. With fall in GSEC rates, corporate bonds and state development loans are trading at attractive spreads over 3 to 5 year segment. Hence, it will be advisable to deploy roll-down strategy to lock in currently available yields.